And it's time for another Macro Monday where I get you ready for the week ahead in 5 minutes or less. As always, this is just a small snippet of our full Macro Monday newsletter. So if you're looking for more in-depth coverage on the week ahead, I highly suggest you check out the link that I'm going to put in the description of this video. I think you'll really enjoy it. And that brings us, as always, to our chart of the week. And if you've been paying attention, it feels like employment data has been all over the place lately. On one hand, you have ADP November report sharply missing expectations with 32,000 jobs lost, and the ISM services employment component softening to 48.9. But then on the other hand, initial jobless claims for the week ending 11/29 fell to their lowest level since 2022. Confusing to say the least. One thing we have taken note of recently, however, is that leading indicators of labor markets have looked more constructive recently. Which brings us to our chart of the week, where we have the NFIB hiring plans for the next 3 months in blue and the unemployment rate in red. While we're excited for the November NFIB report on Tuesday, the NFIB actually releases some of their employment-related indicators ahead of their full report. Interestingly, the hiring plan series from the November report moved significantly higher. This series, in blue, has historically been a good leading indicator, as you can see it's advanced about 3 months, of the unemployment rate, and currently argues for tighter labor markets in the new year. This is consistent with the aforementioned initial jobless claims figure from last week, which also moved significantly lower. Now, this obviously has implications for the Fed and their rate cut decisions, which we will talk about on the next slide, where we get into our week of data. First, though, we're going to start on Tuesday. It is the busiest day of the week, and it begins with, as I said, the November NFIB Small Business Index at 6 a.m. In October, the NFIB's chief economist wrote, optimism among small businesses declined slightly in October as owners report lower sales and reduced profits. Additionally, many firms are still navigating a labor shortage and want to hire, but are having difficulty doing so, with labor quality being the top issue for Main Street. Despite this comment, the headlines index last reading of 98.2 remains consistent with improving activity. Survey commentary highlighted the rising cost of providing employee health insurance, which threatens both profitability and employee retention. Health insurance, childcare, housing, and tuition costs continue to outpace headline inflation. These are areas where the Fed's preferred inflation measures do not fully capture the cost burdens for U.S. households. Also on Tuesday, we get the long-delayed JOLTS report for October. September's print was canceled due to the government shutdown. Leading employment indicators point to continued softening in job openings, though the historical path of interest rates suggests the U.S. may be nearing a cyclical trough in labor market conditions. The data should help clarify the degree of cooling in labor markets and whether the Fed's anticipated rate cut is warranted. And that brings us to Wednesday, which brings the most anticipated event of the week, with the FOMC meeting and ensuing interest rate announcement at 2 p.m. The meeting will include an updated summary of economic projections outlining the Fed's forecast for the policy rate, employment, and inflation. The previous one in September projected 1.8% real GDP growth, with third quarter real GDP tracking near 3.5%. Any upward revisions will be scrutinized, particularly in the context of another 25 basis point cut. As we've noted previously, there is abnormal amount of dissent within the ranks of the FOMC committee on the future path of policy. The odds of a December rate cut have moved between 40% and 95%, bouncing back and forth over just the last few weeks. Chairman Powell's term does come to an end in May, and we're starting to hear more chatter about who his replacement will be. And while we won't speculate, it does appear his replacement will probably lean dovish. And this likely sets the stage for additional easing in 2026. That's what I'll leave you here today. I hope you guys are enjoying the winter weather. If you are in a cold climate, I know in Chicago it's been snowing a lot. I hope you have a great week. Don't forget to subscribe, and I will see you right back here next week for another Macro Monday.